One of these two investment accounts could actually leave you with $200,000 more by retirement. But if you simply check a box on your HR forms without understanding the tax liabilities tied to it, you are actively volunteering to surrender a massive chunk of your future wealth. Wait 10 years to figure this out, and the $50 a month it takes to build a nest egg today turns into $500 a month just to catch up. To fix this, we need to break down the exact math behind these accounts and build a strict step-by-step blueprint for where every dollar should go first. Because the only mathematical guarantee of losing this money is letting confusion keep you from investing at all. When it comes to building long-term wealth, the conversation almost always narrows down to two options: the 401k and the Roth IRA. At their core, they function identically. They are simply empty buckets designed to hold investments, like index funds or stocks, so they can compound over your working years. Where they diverge entirely is the tax code, specifically the exact decade the government decides to take its mandatory cut. You aren't actually looking for the objectively better account. You are making a calculated bet on whether you want to pay taxes based on your income bracket today or the bracket you expect to be in decades from now. Let's look at the 401k, which operates on a simple philosophy: pay your taxes later. Every dollar routed into this account comes out of your paycheck before income taxes are applied. That creates a highly efficient shelter, lowering the total taxable income you have to report to the IRS right now. But that tax bill doesn't disappear. It is deferred. When you retire and start pulling that money out to live on, you pay taxes on every single dollar, including all the compound growth you earned along the way. To incentivize you to accept that future liability, most companies offer a 401k match, meaning they will contribute their own capital alongside yours up to a certain percentage. If your employer matches your contribution dollar for dollar, that is an immediate, guaranteed 100% return on your investment before the market opens. A 401k guarantees immediate tax relief and captures free corporate funds, but requires you to accept an unknown future tax rate. The Roth IRA takes the exact opposite approach. Its philosophy is, pay your taxes now and never pay them again. You fund a Roth IRA with money that has already been taxed. You feel the pinch immediately, resulting in a slightly smaller take-home paycheck today. Once inside, those dollars compound over decades through the exact same index funds as a 401k. But the Roth IRA is protected by a radically different tax shield. If you hold the account until the official retirement age of 59 and a half, every dollar you withdraw is completely tax-free. The government cannot touch a single penny of your accumulated growth. By forcing yourself to stomach the tax hit on your seed money today, the Roth IRA allows you to buy absolute immunity for your entire harvest later. To see how aggressive that difference really is, let's look at a 25-year-old investing $500 a month for 40 years, assuming an average historical market return of 8%. Over those 4 decades, that principal explodes into a gross total of roughly $1.7 million. Looking at this minimalist line chart, we can map out the 401k outcome. The compounding line rises to peak at $1.7 million, but then a massive red chunk is severed from the top. The IRS takes its deferred cut. But tracking the Roth IRA, a green line draws alongside it to the exact same $1.7 million peak and stays completely solid. Depending on your tax bracket, avoiding that final tax levy on the compounding growth is exactly where that $200,000 disparity is created. The math makes the Roth look unbeatable, but the most profitable strategy doesn't force you to choose just one account. It sequences them. This is the optimal blueprint. Step 1 is funding your 401k strictly up to the limit of your employer match, and not a single dollar more. For Step 2, you redirect all remaining investment capital into maxing out a Roth IRA. Finally, Step 3, if you still have savings left over after capping the Roth, you pivot that surplus back into the 401k to maximize your total market exposure. We cap the pre-tax investment temporarily because managing a secondary Roth account is the only way to lock in tax-free withdrawals on the bulk of your wealth. This sequence operates like a trap. You mathematically capture the free corporate money first and secure your tax immunity second. This sequence assumes an average income, but your current salary dictates how heavily you should lean on each step. If you are in your peak earning years and sitting in a high tax bracket, You might prioritize maxing out the 401k first to aggressively shelter your current income from immediate taxation. But if you are a young professional in the lowest tax bracket of your lifetime, prioritizing the Roth IRA is non-negotiable. Your current tax burden is as cheap as it will ever be. Whichever route you take, time is the only asset you cannot buy back. Compound interest requires decades to generate these multiples. You have the math and the sequence. The only thing left to decide is which step you will execute with your next paycheck. Because the most perfectly optimized financial plan in the world generates zero returns if you never make the first deposit.